afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is Kelvin Wong. On the 18th of August, he's the Senior Market Analyst from Oanda. Kelvin, it's always great to have you on the show.
Most welcome, Brian, and good to see you again, and as well as happy Friday.
Now, Kelvin, before we get your insights, we're going to take a look and see how the numbers across the region stack up. We're going to start with cryptocurrencies. Bitcoin is way down at 26,205. It's down 8.51%, continuing its losses. Ethereum is at 1,666. It's down 7.39%. Now, looking across the regional equity markets, we start where you're at in Singapore. The Straits Times Index is down 0.69%. Bursa Malaysia is down 0.12%. Shanghai is down 0.13%. The ASX All Ordinaries bucks the trend. It's marginally up at 0.05%. The Nikkei is down 0.63%. The Hang Seng is down 1.13%. Rounding up the numbers, we've got the Kospi, which is down 0.58%. Kelvin, generally red across the region with the exception of the ASX. Tell us why.
Yes, so precisely what we see over here is that the primary negative feedback loop or weakness that's seen in the various Asia stock benchmark indices has been primarily driven up from China. Firstly, fear of a deflationary risk, now spreading on to a fear of what I call a contingent risk that's being seen in the China financial system. Number one, early part of this week, or late last week, we start to see a major trust fund company that has failed to make timely payment on their wealth management product. And what's interesting over here is that the wealth management product, the assets that actually derive the return of this wealth management product came primarily from this indebted China property developer asset, which is their properties. Okay, so what we could see over here is that China property market has been in pretty much of a downturn in the last 3 to 4 months, primarily driven by the fact that the China top policymakers do not want to see kind of a return of what I call cowboy practices. I would say that in the China property developing space, that means i.e. developers loading on huge debt, ignoring best practices. And what we could see over here is that due to this tightening of this business practices that is inherent right now by China top policy makers towards this property developer, that particular, we call it problematic indebtedness, or what I call it earnings, we call it earnings lethargic or earnings fatigue of this property developer from the private developer. That means what we start to see in like the likes of Country Garden, now spread on to what I call the China state-backed property developers that's really start to sound the alarm, saying that over here is that they may start to face major losses on their balance sheet due to this lackluster environment that is kind of being indirectly dictated by China top policy makers. So the next question I'll ask right now in being market participant is, will this actually drum up China top policymakers' current targeted fiscal stimulus measure? Because if you look at the last 6 months or so, yes, China policymakers has been kind of promised the market that yes, they will do something to address this lackluster growth in China. But so far, things has been pretty much of a piecemeal basis. And I would say that also due to related more of, we call it morale boosting announcement, rather than we start to see what sizable or more concrete layout of physical stimulus plans that they want to enact on.
Now, Kelvin, the numbers that also came out today, which worried markets, was the Japanese inflation numbers. It remains elevated. Core inflation rate at 4.3%, which is above the 4.2 in June. It's a 42-year high. What is the impact on the Japanese yen and also, of course, on regional markets?
Yes, so definitely. So right now, if we look at the current situation right now, let me touch on the situation on the inflation rate first. So definitely the core inflation rate, that means the one that is excluding food and energy, came in higher in the month of July at 4.3% year on year versus 4.2% that was recorded in the month of June. So that's close to about a 42-year high. So what we could see over here is that definitely a stronger or I would say I put it with a higher, sticky, elevated inflationary environment in Japan, it actually supports a stronger Japanese yuan. Okay, so right now the question over here is previously, in terms of market correlation, is that if we start to see a strong yuan, Japanese yuan, that's actually negative for Japanese stock market. But that doesn't seem to be the case right now, because if you look at the last 3 to 4 weeks of price action, the Japanese yuan actually has been weakening. That means dollar Japanese yen going up. Okay, that means yen weakening, dollar Japanese yen went up. So it almost went to a high of 146.56 in yesterday's Asia session. So, but that actually did not actually support the Japanese stock market. So the Japanese stock market actually continued to plummet yesterday. So what's interesting over here is that there's actually a multi-factor at play. One factor to look at is over here is that, yes, definitely also we talk about the Chinese yuan that is actually weakening as well. Okay, so it means dollar CNH strengthening against the Chinese yuan. So that actually caused a bit of what I call indirect downside pressure on this Nikkei 225. So what we could see over here is that perhaps, right, what we see, strengthening yen could actually bode well for Japanese stock market. I mean, that is a bit unconventional. Why? Because if you look, if the yen were actually to be strengthened, it actually will actually encourage, number one, more repatriation of Japanese funds away from, let's say, for example, other fixed income market like the US Treasury back towards other, we call it Japanese asset that could actually potentially yield much better, like the JGB, for example. Or perhaps what we could see over here is that if we start to see inflationary coming back into the picture of Japan, Japanese corporation will tend to actually invest more in their capital capital assets, or we call it the fixed assets. That could actually encourage banks learning banks, we call it borrowings as well. So that could actually be positive for banking stocks. So that's something to keep an eye to watch out for. But nevertheless, the big wild card over here is the Chinese situation over here. So if you look at the last 2 weeks, global equity markets sell-off has been primarily driven by this deflationary risk coming out from China. We talk about country garden indebtedness that is blowing up, that is causing a contagion risk in the China stock market. So one thing before we're going to highlight over here is, yes, Chinese authorities has now sounding about alarm, especially the concern about the weakening Chinese yuan. So in fact, China's policymaker has instructed this China State Bank to actually intervene, or I would say encourage to intervene directly in the FX market. That means, i.e., to actually buy up the Chinese yuan against the dollar. So you look at the dollar CNH, right? Yesterday they managed to actually retrace a bit of sell-off that's been seen at a key resistance level at 7.3450. So if the dollar CNH going to actually fall from this level in a couple of days' time, that could actually add a bit of support right now towards the Japanese stock market.
On that note, Kelvin, thank you very much for your insights. Thanks for coming on the show.
My pleasure, Brian.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.